Welcome back, everyone, to the European VC podcast. Today, I have Ertan Can with us, and we're going to talk. Ertan, of course, an LP and fund investor from Multiple Capital, the founding partner there. We are going to talk all about why microfunds are actually worth the hassle. And after that, after Ertan having given a presentation on this topic, which is only 10 minutes, so we won't ask you to sit through something too long. If you watch this or listen to this, you might consider walking over to your computer or grabbing your phone and watching it on eu.vc just to see the slideshow that Ertan has going with it. But if not, you'll be all right as well. He describes it quite well in the voiceover. After that, we go into a long conversation about the pros and cons of small/micro VCs and whether normal LP in Europe, so to say, would be wise to invest into these funds or not. I hope you enjoyed this episode as much as I did making it.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Mr. Ertan, welcome back on the European VC podcast.
Hi, Andreas.
So, Ertan, today we're going to do something a bit different because I invited you to come to Go West together with my good friend Sophia from the Go West team. And we did so because we wanted someone to come talk about the power of micro funds from the LP perspective. And you accepted the invitation to do that. And that is exactly what we're going to do now. So we're going to do the LP perspective on why micro funds are worth it as an LP. Some might even say the best strategy for an LP if you want to achieve alpha in venture. And I basically just want to allow you to go directly into the presentation. You give us that 10, 15-minute presentation, and then after that, we have a conversation on the back of it. Are you up for it?
Perfect. Yes, absolutely. Let me start with the presentation then. It's around 10 to 15 slides about fund size in the end and why fund size makes so much sense in venture. So one of the data sets is that 75% of funds with a multiple of 3x or more were small funds. That's 3 and 4. So that's really a lot in percentage, and that are part of that 3x world. Here we're talking, and I think that is repeating now. We're talking mostly about PitchBook and Preqin data. And I personally think that PitchBook and Preqin data, first of all, sometimes is outdated, but second of all, never covers really what we call micro VCs a lot. So even there, it's limited to 10 to 250 million. So rather a larger set of what we wouldn't call micro VCs anymore. But even with that larger set, the percentage of 3x and better funds is 3 out of 4 or 75%. We think that the numbers are even better if the funds get smaller. So if PitchBook would have the data on funds, let's say up to 50 million and not 250 million. So probably most of you know that statistics. A lot of other people shared that in the last month. Here again, it's just very visible that small funds, in this case, not small funds, but emerging managers. And I will come in a second why emerging managers are most of the time small funds. But here you can see that emerging managers are most of the time outperforming larger funds. Same thing here again. We think that Cambridge Associates, not even tracks most of the small funds. So it still is relatively limited. And even with that limited database of small funds, in this case, small funds outperform over a long period. In most cases, we're talking here about top 10 funds, all the other funds. Now, why are emerging managers small funds, or why is that such a big correlation between that? So first-time funds raise on average way smaller funds. It's very logical, right? And we think that first-time funds and emerging managers is more or less the same thing. So first-time funds usually, or even second-time funds, in most cases, raise on average much smaller funds. So for us, micro VCs mostly are first and second, and sometimes fund 3, but it's mostly what others would call emerging managers. But we would consider, for example, a fund that is fund number 4 or fund number 5 if it's still a small fund. Again, in looking at another PitchBook data set, the majority of outperformer funds, 65%, are below 100 million fund size. So what is an outperformer fund in that data set? It's 5x plus DPI funds. Again, another data set showing that 65% of 5x DPI funds are below 100 million. And then even another 17.5% are between 100 and 200 million. Still, for many, would be considered smaller funds. So I would say, together it's more than 80% performing 5x or more are relatively small funds. Here we've broke it down. 10 funds were larger than 200 million fund size out of that data set. 10 funds were 100 to 200 and 37 funds were below 100 million. Same thing here again. We think PitchBook does not cover the lower end well enough. If they would cover the lower end of small funds well enough, the numbers would look probably even much better than that. This is a very old statistic, but still, I think is one of the most interesting visuals showing how funds perform when they are getting larger. So this is a Kaufman Foundation data set. It's already from 2012, so it's more than 10 years old. But it shows one thing very interestingly. The percentage of funds that are, when looking above on this data set, it's large funds above 250 million, the percentage of funds below 1x, 1x to 1.5x, and then getting better and better. And you see it's only 1% that are 5x and plus. And if you look at smaller funds, which they summarize in 50 to 250 million funds, you see that the numbers are getting much better. So you have a higher percentage of those funds being performing 5x, 3 to 5x, 3x, etc. Or in other words, 51% of the larger funds perform less than 1x based on the Kaufman Foundation data set from 2012, and almost 50% of the smaller funds perform on the better end, which is above 1.5x. So that's still, in my opinion, a very interesting data set, and still probably similar today when we look at the markets and see how the markets have performed. Another from Preqin, same thing with Preqin. If you look at the Preqin data set, most of our funds that we invested in are not even covered in Preqin, so they are missing a lot on the lower end. But still, the data shows something very similar, which is smaller funds below 100 million and funds between 100 and 400 million. And if you look at that data, interestingly, there is a kind of focus on that even 100 to 200, 100 to 400 million funds, because in the data sets of Preqin and PitchBook and Cambridge Associates, this is probably the lower end, 100 million plus is the lower end of smaller VC funds that they really cover. And that's why you see, in many cases, similar returns for these kind of funds. We think if they would cover the smaller end good enough, the numbers would look different. But even though that is the case, you see that the smaller it gets, the better typically it gets when it comes to performance. Old statistic here from the Kaufman Foundation, but interestingly, very similar outcomes. If you look at the real outliers, there is a concentration on smaller funds, on the smaller end, right? We have visualized this here, whereas if you look at larger funds, you see that even above 1.5x, there is nothing. And on the second page, you see that Kaufman Foundation, at least, had no single $1 billion or larger fund returning more than 2x after fees. So that's very interesting. And here again, the smallest end, you can see has those outlier returns. Whereas the larger it gets, we always draw something like a line here. The larger it gets, the more difficult it gets to pay back good returns. A lot of people speak about volatility and stability of returns of smaller funds. If you look at the horizon pooled IRR returns, and everyone knows I'm not a big fan of IRR, but if you look at the pooled IRR returns, again based on Cambridge Associates here, it looks rather relatively consistent. What you have in returns here. The pooled IRR, which means all IRRs for small funds below 100 million, is still relatively concentrated. As you know, we are a fund of funds, so we believe in a portfolio of small funds, not in one single or one or two or three. We think it's very difficult to select the best fund. We try to select the best funds or some of the best funds, and ideally hitting some of the outliers. But in general, if you look at the total market, the returns are relatively stable. That's what this data set shows. And then this is another data set about the rise of micro VCs. So funds that were raised, in this case, even below 50 million. So it's a huge increase. Everyone knows that. We think this data, again, from PitchBook is very, very limited. We think that the real number is probably 3 to 4 times higher if you really count in all the funds that want to raise a 10 million, a 5 million, a 50 million fund. I think it's just natural that or logical that PitchBook can't have them all on their platform, even us. So it took us almost 5 years until PitchBook took us into their data and into their platform. So I think for most new funds, it's not the typical thing to be on PitchBook. One thing that many people don't look at or never looked at is the management fee side. And we can see that small funds, and again, this is on average, small funds have typically more like the 2% or 2.2 to 2.5% percentages. As you can see, most are around 2% because they start and they have to have usually a standard fee model. And so you see that increase in fees the larger the funds get. And here you see like the blue ones are the majority of funds. When the funds are getting larger, the majority of funds seem to have more like 2.5%. Why? Because they can. So many of the super branded funds that are oversubscribed and getting larger and larger ask for higher fees. And that is something that was quite interesting for us, that the smaller end, and no one talks about that, but this is a huge benefit for a small fund, that the fees are not 2.5 or 2%, because the fees make a lot of difference if the funds are also larger compared to smaller funds. So you see that trend very clearly, that bigger funds, probably all the brand name bigger funds, have usually higher fees than the average of the smaller funds. This is a lot of text, but I'd like to focus on only one thing here. Small funds need lower exit valuations than larger funds. I think this is common sense, and we just calculated in some examples, and we think that the valuation of a fund returner in a small fund has to be around $250 million. Valuation of a fund returner of a 100 million fund has to be almost 3 times that number, $670 million. And for a 300 million fund, you need a 1.5 billion exit. As all of us and you and me know, we don't have a lot of 1.5 billion exits. So again, it's a plus for smaller funds. If you have a smaller fund, your exit returns proceeds don't need to be huge. You can return funds with far smaller exits. And I think that's my last slide. It's about Samir Kaji, who posted something on his newsletter. How should LPs think about VC fund size? And I think he summarized one thing about small cap venture. And small cap venture for him are, again, funds up to 250 million. But what he says is, the highest return potential with corresponding volatility have small funds. Manager selection is crucial. It's probably best suited for maximum return seeking portfolios. Now, what he has not mentioned is the thing that, the combination of manager selection and return seeking and high return potential is even better if it's a portfolio of small funds. So if you build either yourself or through a fund of fund, if you buy a portfolio of small funds, I think you also answered that part, which is volatility. So we can see in our portfolio, for example, that with a larger portfolio of small funds, the volatility is very much limited or reduced. And so you can benefit from what it is probably what venture capital initially was, buying very early with small amounts and benefiting a huge if it is an outcome. That is huge. So this is my presentation.
Thank you, Ertan. Thank you. There's a bunch of knowledge in there that I think many of our regular listeners on the podcast have heard many times and seen many times. It's debate that's ongoing on LinkedIn constantly. But there are some things that I would love to ask you to maybe dig a bit more into and get a bit more controversial on, or just more candid on. One of them is if I asked you, where do you see most people most often getting it wrong? And here I mean from the LP perspective, getting it wrong when they're thinking about large funds versus small funds.
It's a good question. So getting it wrong, I think one thing is that large funds typically have a much more solid brand, are much more recognized as a brand, have a much longer story that they can offer, and also success stories. If you were a successful fund in the past with your smaller or initial funds, you have this success story already today and can present it and say, we were invested in the past in this company and that became a decacorn or a unicorn. This helps many of the larger funds today to be more present within potential investors, LPs, also within multipliers like fund placement agents, banks, people who are willing to place you, the Moonfirst of this world, right? So they are selling brands. They're selling not really returns or future returns. I think that is probably a misperception, or not a misperception, but a difference between LPs accessing larger funds versus smaller funds. What do they do wrong when they I think it's not about wrongdoing here or getting it wrong. I think it's about not doing it. It's a lot of work. It's a lot of effort to invest in small funds because they are not known, right? So they're you have a lot of them. It's like seed rounds or angel rounds. You have multiple of seed rounds versus A or B rounds, right? And it's super difficult to select and pick the right ones, in my opinion. For funds, it's not as difficult as for seed rounds because you don't have 10,000 seed rounds a year, but you still have 500 to 1,000 funds a year where you have to do a selection. And I think this is probably the biggest wrongdoing, that LPs are not taking the resource, the time to look into the whole market and do a selection. So, when you think about what Samir wrote in his newsletter, it's, manager selection is crucial. So to do manager selection in small funds, in my opinion, you have to do the work of meeting and seeing a lot of small funds and then deciding based on what you've seen on what to choose.
What is the magic number for an LP? Where would you say that a family office should be comfortable underwriting a fund manager?
Yeah. So the number of fund managers per year.
Yeah, and the time dedicated, so
Yeah.
on. Like, what does the setup for an LP look like before they should start dabbling into small funds, so to say?
Yeah. So we think to cover the European market, you should look at 500 to 1,000 funds a year. Samir thinks that it's 200 to 300 funds a year to do 5 investments per year. We think 5 investments is not enough to cover a market every vintage. We think it's rather a 10. 10 is the number, but something between 5 and 10 is probably a good size, right? So if you want to cover something like Europe, if you go global, it's a different number, right? So because you have to do 5 to 10 funds in the US if you do 5 to 10 funds in Europe, at least, to cover the US and Europe, and probably the rest of the world another 5 funds. So, and it's a different work. Even we don't do really globally sourcing every fund in the micro worlds. It's just impossible for a smaller player like us, and for most players in the world, in my opinion. So the right number, I would say, is 5 to 10 bets every vintage in micro VCs. And probably for doing this, you need to look at something like 300 to 900 or 300 to 1,000 funds to do the 5 to 10 bets.
So here I'm being devil's advocate, and maybe a lot of people will hate me for it. But you see a lot of emerging managers, VC managers, not fund of fund managers, but VC managers on LinkedIn a bit talking to the LP crowd that this is why you should do emerging managers. And then they come with all the multiple and returns arguments that you have. But I just always feel like, well, if you then look at the average LP that they're engaging with and the setup they have, they're not meeting 300 to 1,000 funds
Yes.
every year. They're not making 10 bets every year. So I actually think that from the asset manager perspective or the deploying side's perspective, there are many good reasons to not maybe do as many small micro funds as we in the ecosystem would like them to.
The many reasons not to do many small micro funds. Why do you think that? Say
In
again.
the sense that those reasons are not connected to the asset class, so to say, but they're connected to their own internal processes and their own work in the asset class, meaning that the majority of the LPs that allocate to venture do not meet as many managers as you described.
Correct.
They do not have enough time. They do not do as many bets as you describe. And for that reason, even regardless of everything else, that we might say, well, if you do a pure VC fund investing strategy and you do dedicate all the time in the world, so to say, to meet everyone, then it makes sense to do a micro strategy.
Yes.
But given the setup that they have, they would actually probably be better off capturing that exposure by the likes of Multiple and Isomer and all
Yes.
our fund of funds that do the work that you describe. And then if they want direct exposure as well, they do some of the more established funds.
So I think what you're talking is also about, the risk perception of venture. First of all, yes, I agree with you that most LPs wouldn't take the time and the resource to screen enough funds to do a selection of micro VCs. First of all, they wouldn't meet as many, and second, they wouldn't do enough commitments. So even if they would meet 100, they wouldn't do 5 per year, which would not be good because 100 would be just a fraction of the market. Okay, but let's say they meet 100. They would still probably, most of them, not do 5 investments per year. So it's kind of lacking, and I agree with that. The question is, what is the alternative? So the alternative could be investing into a platform fund, a larger brand, where they feel more secure, less volatility, less dispersion of returns, etc. But here again, data shows that even larger funds don't always promise this kind of solid return that you would expect. So even with larger funds, you would have to diversify, of course, usually. And even if you would diversify with larger funds, you would still underperform compared to smaller funds. Now, the other alternative is to invest in fund of funds like Isomer or Multiple. And it's one of my next posts, by the way, in the fundraising series. But what I realized is, and you know that as well, that probably today in Europe alone, probably something like 40 to 50 new fund of funds. I don't know if all of them are investable, but for an LP, even looking at 40 to 50 fund of funds, and compare fund of funds would be a task that most LPs wouldn't have time or resources to do. So I'm not talking about funds or direct, which is another layer of, different risk. Because if you invest direct, even a C round or D round, which you would consider a super low risk, can fail, right? But so what I've realized, most LPs not even don't forget looking at the whole market of VC funds, large or small cap. Forget about that. They're not even able to look at the whole market of funds to select, one or two right fund of funds for their portfolio mix. I think it's already a task for most family offices, for example, to do that one, and that would be probably the more logical answer, instead of screening or meeting 20 managers and doing 2 investments and thinking, oh, now we have deployed into micro VCs. There is a difference, by the way. I think if someone, whatever the reason, doesn't want to do a micro fund, a fund of fund, like us, and there are several reasons why people are not, I think the best alternative, and I'm not recommending here any fund, but the best alternative would be still a fund that is highly diversified, right? So that does something like 100 to 300 investments in one single fund. And there is, I think it's another data set that we want to publish publicly in the next weeks, month. There is even, interestingly, if you look at all those funds that have this high diversification, you can literally see how they perform on average really well. right? So on average, you have a better bet if you find a fund that invests in 300 companies or 100 companies every year, even though it's a spray and pray model. So that's the biggest difference, I think, between a fund of fund and a fund that invests in 300 companies, in one single fund. Because 300 companies means you have to be broadly investing and you're not concentrated in any of the investments that you do. Whereas a fund of fund invests in a single manager, and the single manager is very concentrated in what he selects. Usually, we invest in concentrated funds, and they again are very concentrated in the picks. So we consider our portfolio much more concentrated in selecting the companies compared to a single fund. But I would recommend rather this kind of sheer spray and pray fund versus any single fund if you don't build a portfolio of funds.
Just to comment on that, we have a full session happening in not too long, only on this constant debate that's also in the market about the concentration you want in a venture fund. So whether you want to do spray and pray models, as some might call them, or you want to go much more concentrated. So we're doing the pros and cons of that, reserve strategies, all of it into one.
Andreas, the reason why I mentioned that or said this is because it's closest. The spray and pray fund is closest to a portfolio of companies, large enough. So that is the reason why I think if you're not building a portfolio yourself by selecting several funds or investing into a fund of funds who does this selection for you, then the closest to that diversified model is a spray and pray fund that does 100 investments per year.
And on top of this, now we're just talking the numbers game, right? But there's also the point that most micro funds are specialists either in a geo or in a vertical.
Correct.
So if you do a micro fund bet, you don't just have exposure to venture, you have exposure to B2B SaaS in Denmark or something like that. Most often, unless you do the more established players that are then
Correct.
most often at least in a plus 100 million size range.
I agree.
There's another thing I wanted to ask you. David Clark from Vencap, of course, is one of the big voices in this conversation always. And he is saying, and I wanted to ask you about this, that the data, you touched on it in your presentation as well, the data is always with quite some lag, always 5 years or more old. And a lot has happened in the market since 2019. So where do you see the venture market moving? And do you see it playing in the favor of more micro funds or for strategies directed at micro funds? Or do you see it bifurcating so that only the very best small micro funds will be able to keep deploying that type of strategy, but then we'll have more of the larger hybrid crossover funds, that type of thing? Where do you see the European market moving?
I think there are some tendencies from the biggest backers of funds in Europe, the public institutions. There are some trends or tendencies to back more or to create bigger funds with the mindset of, Europe needs more growth funds, late stage funds. And so I think because of that, there will be more, 1 billion funds coming into the market in the next years, being focused on later stages and growth rounds. That's a fact. That's more or less a fact because it's already decided, and this will come to the market. I like the comments and the posts of David from Vencap because he's putting a different perspective, and it's very interesting. I mean, it's of course all of us have an interest because we do some a specific business, and his interest is different because Vencap has a slightly different business model than we do. I have one, of course, and of course we are claiming small funds are performing better. At the same time, he claims, it doesn't matter if it's small or big. It's about the best managers. To be honest, I don't know who the best managers will be in the future. I truly believe that it's very difficult to pick the best managers today. And if it's pickable, so if it's visible today, then it's definitely not a small fund because a lot of others will have the same opinion about that fund. Right, so it will be a rather large and even larger fund than 5 or 10 years ago. This is, by the way, the reason, if I show those data, which is the available data, which is 5 years, 6 years old, I think today it's probably even the thesis of the data that we are showing is probably more the case today even compared to 5 to 10 years ago because the fund's getting larger. If you think about insight Just to name one name. Insight, I think the last fund was a 20 billion fund. The fund before was a 4 or 5 billion fund. So when talking in sizes, that's almost unimaginable. I don't understand how they will return this kind of number, 20 billion. And maybe Insight does will return that. But others who raised similar large funds or quadrupled, tripled their fund sizes, all of them, it will be just almost impossible to meet the return claims, the expectations. And if all of them will return this kind of expectations, then imagine what will happen to the micro VCs. Because all the micro VCs will be earlier in these companies. If you have 100 unicorn exits and 10 decacorn exits in the next decade in Europe, then of course our portfolio will also be a huge outlier. Most probably. Why? Because some of those 1,000 companies will be some of the unicorns and the decacorns. So it's a very natural thing. We don't believe that this will happen. It will be probably a disaster for the smaller for the larger funds. At the same time, I have to say, and to be very honest here and very transparent, the smaller end becomes also more difficult. If I compare that, 10 years ago, Andreas, I looked at 50 funds a year. It was very easy to select 2, 3 out of that 50 10 years ago because, it was easy. Now, looking at 10 to 20 times the number, it's much more difficult to pick the right ones. And that's the reason why we don't do 2 anymore. It makes sense to do 10 today because if you look at 500, 10 feels like the right number, to have enough geo-focused and specialists in your fund covering enough areas, where outliers can be created. So I think it's not getting easier, in my opinion. And everyone who thinks, okay, investing into microfunds today is an easy thing, underestimates the resource that you need to really cover. And you do a great job by interviewing every week some of them, right? So if someone would take the time just to listen to each interview that you do with small funds, that's already a huge resource that you would take to listen and educate yourself and make an opinion about a single manager.
Yeah, I think of us as a crowdsourced or open sourced sourcing platform for for LPs in Europe.
And still, don't forget, even your interviews is a fraction of the market in the end. And even your interviews is just, in most cases, I think 30 minutes of an interview, where it's you have to say, and we know that, and I'm listening to most of them, by the way, because it's a kind of free resource for me, to listen to that manager. And still, it's a selling 30 minutes. It's a positive thing, and that you never have a negative interview, right? So it's most of the time a very good, interesting, positive interview, and you still have to make a selection.
Can I ask you, Ertan, how do you think about, because you said it before as well, that David from BenCap is very much of the perspective, it doesn't matter whether it's big or small necessarily. What matters is that it's the right manager, that the manager selection is good. Another way to describe that, or at least a perspective that I have definitely also heard, is, well, I don't care that much whether it's Denmark or France or vertical SaaS or quantum. I care about the manager, and if the manager is great, I don't mind that I have another bet in the Nordics already, and I don't think about having geo dispersion and so on. How do you basically talk to LPs about their own direct strategies, and I ask you this two-sided question because it's a bit different whether you're a family office deploying here and there, so to say, versus having a fund of fund where you have a 4-year or 3-year deployment period where you're then making your batch and you need to do a full batch that then covers whatever is your thesis.
Let's pick one single market. Let's pick London. Okay. If you look at the emerging managers coming out of London, I think they have the best setup usually, brand setup, selling, communication, social media, whatever you need, network, they're the best network because they are in London. So usually what the trap that we found ourselves in is, to to see a lot of funds in the UK, and compared to, let's say, a Finnish manager or a Hungarian manager, or a Polish manager. And so if you compare that, of course, the London manager seems to be much more, rounded, networked, access to London deals. But then at the same time, if you would invest only into London-based managers, okay, you would probably underperform the market. So the biggest outliers we have are not from London. Even within the UK, they're not from London, right? So it's very interesting, and I think you have to be bold enough to do investments, even though you're, from the perspective, it looks like the London-based managers are the best. And if you look at, by the way, it's a very interesting. I don't find enough data around it, but it's more like a gut feeling. What I see, from what I see in the market is most of the LPs invest in local markets. If you're a London-based family office, you invest in London-based VC funds. You typically don't invest in outside. And if you're in Berlin or Germany, you invest mostly into German VC funds, and it's probably the same in all other countries. In some cases, the funds have literally only local national LPs. If you look at some
just
countries.
to add a comment to that, I tend to call VC a bit of a patriotic asset class in the sense that many LPs allocate with their heart, at least when it comes to picking where to invest and what areas.
It's also having access, right? So if you're a London-based manager, you typically don't see all the potential investors in Germany or in Austria or in Switzerland or in Stockholm. Usually it's not the case. And the same vice versa. If you're in Stockholm, you typically don't know any of the, family office in Munich if you raise a 20 million fund in Stockholm. So it's a very local, the smaller it gets, it's a very local business. There are some exceptions, of course, where people are super well connected and they raise from angels all over, or GPs all over Europe. But that's rather rare. It's not the common thing. The common thing is, people pitch their network, their existing network, and that's usually in one country.
Do you think that the intransparent nature and highly networked nature of venture means that there's a huge adverse selection for LPs that are peripheral to the ecosystem, just as there is on the startup side? What I mean is, if you're a tech founder who have seen liquidity, the funds you'll be offered will most often come from very strong networks because they come from your past investors and other well-performing founders and so on. If you're a random family office that has made their money in the old industry, and you're then in the newspapers, for being wealthy, basically, you get poached by everyone.
Correct. Not only venture, by everyone.
Yeah.
In all markets.
Yeah.
So you're getting approached by real estate agents, by infrastructure funds, by private equity funds, by everyone, right?
Yeah. Do you
By
see
private banks?
Because this is a bit my thesis, that there's definitely a bifurcation of LP returns to the people that are in the right networks already versus all the rest.
It's a long discussion. But let me try to answer it so it's also something I think where we have to reflect again and again and see what our strategy and what our thesis in detail looks like, and if the network is enough. Because what we also realized is that some of the, especially in emerging managers, right, some of the most interesting funds were completely underdogs, where they were not in the right networks, where they didn't have an easy time to raise their first fund, where it was very difficult and no one believed in them, and still they became like one of the biggest outliers. I think venture in general, and there was a great fireside talk at the Vintage Summit in London by Mike Maples, the Floodgate founder, Floodgate GP. And Mike Maples said, it's venture is all about the, investing into something that is not common sense. So that is not where not everyone believes immediately that everyone should invest in it. And he gave several examples on, Coinbase initial rounds, Airbnb's initial round, etc., where he said no one believed in that model in the initial phase. And I think there is a risk for LPs as well as VCs to be in that. There are several words, capturing that, but to be in that network, in that circle, where you see only the things that are relevant in that circle, and everyone believes, being in that circle is the right thing, and then it will deliver the best returns. I compare it sometimes to, if you're an academic, okay, and your kids, the probability of them being an academic is very high, right? You know that. So
Yeah.
being an academic and being from a worker or immigrant family, the probability is much higher if you're from an academic background that your kids are becoming academics. But it does not mean that they become super successful in life. So the average will be slightly higher. Okay,
Yeah.
if you want to increase the probability slightly, and having a slightly higher probability of being in the right things on average, but also in our case, in our business, paying a higher price to be in the right things on average, so which reduces your returns in the end. That is probably right. Like, if you're a kid from academic, yes, you will be a lawyer, but it doesn't mean that you will be a superstar, right? So that doesn't mean that you will be an outlier. You will be most of the kids of academics will be standard lawyers or standard people, right? And I think to hit that outlier, maybe, and that's just the thought. I don't know the answer about that, but maybe we have to think outside the box. Maybe we have to bet on things, regions, verticals, where the network is not focused on. And I think our job is, in venture or as a fund of fund, is not only, one thing is fund size, and we're very much focused on small funds, but the other thing is, how do we find the next underdog? How do we find the hustler that believes in something, like a founder, right? Like a founder is, when you find that super hustler who believes and understands something that no one else believes in the beginning, but then this becomes something very, very interesting and very large. So I think my job is something similar, but investing into funds. And am I right all the time? And can someone be right all the time? It's impossible. So of course you have to give the percentage of being wrong also within your decisions. It's impossible to be always right, but we have to be a little bit more right than wrong. So that's maybe the real answer.
Right. That is what venture is about. And when you're right, be very right.
Yes.
Ertan, thank you so much for joining us for this episode and for doing the work of putting together the presentation on why small funds are worth the hassle.
Thank you very much.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.